Hello everybody, welcome to my video about how to create the calculate the average monthly return, annual return, standard deviation annual, axis return, axis of standard deviation, axis return, Sharpe, skewness, kurtosis, alpha, beta, r squared, treynor, correlation, and expected return according to the CAPM. So the reason I like doing this on Excel is because through standard websites like Yahoo Finance and stuff, they don't really have everything. I mean, maybe if you subscribe, they have everything, but I mean, you can get it for free on Excel. And once you calculate it once, you can calculate it for anything that you can put into Excel, which is like ETFs, stocks, mutual funds, which is a lot. And let's get started. So we want to start from, we got to set our dates we want to have the function go from. I usually go the past 5 years, and today is 12/4/2025. No, not 2025, 2020, but I want to do from, so 2015. And then 12/4/2020. I did 5 years because I just like it works, and if you look at the betas, they're always usually the same with the websites. So I'm assuming they use the last 5 years too. Now, we got to find a stock that we want to calculate for. Let's do Microsoft. All right. And then we got to go to data, stocks. And it doesn't know what stock it is. All right, it's Microsoft. Now you have to check if you have this function right here, stock history. If you don't have stock history, then you might have to use the beta version, because you have to go get access to the beta version. So it's still in beta, but it might be rolled out soon. I don't know. And they said they could change how the formula works, which is kind of scary because I already built a whole model on it. So let's just hit stock history. So what are the functions of stock history? We have the stock, which we just put, and make sure you have the columns with the stock. You got to hit stocks. You can't just put the ticker. It won't calculate it. So let's do stock. Start date. We just have the start date. End date. Interval. I do monthly just because I don't want to have a huge spreadsheet. I just like to do monthly. You can do whatever you want. No header for me. I like to use the close. Actually, no, go back. I like to use the date first, so I see where it's all at. Then I do the close. And then close parentheses, that's all you need. I like doing very simple. About 60 columns, or rows, and 2 columns. Now, we got to calculate the change. We can't just, the stock price by itself doesn't give us anything about the returns. We have to change it. So this divided by the one before it, minus 1. And then carry that down. Now we can calculate the average monthly return. Equals average. Take it down all the way. And then annualized return. I have the formula right here for you guys. X is this number. Y is your interval. I call it the interval because if you said instead of monthly, you chose weekly, there's 52 weeks in a year. So you got to do 52. Monthly, you got to do 12. But the trick is, if you do daily, you can't do 365 because the stocks aren't traded 365 days a year. They're only traded on average 252 days a year. So just note that. So let's do that. This is the equation to, again, convert monthly returns into annualized returns. This number plus 1, close parentheses, squared by, let me see, by this number, close parentheses. I'm going to add a parentheses here, and minus 1. All right, so we got a 33% return. These are all in percents. Yeah, all of these are percents. Let's hit percent. Bring it out. All right, standard deviation. Now, there's 2 formulas for standard deviation: population and sample. I do sample. I know some people use population. It just depends how you look at it. I see, because we're doing monthly. It's not the entire spectrum of what we could, you know, it's not the whole population. The population would be like every single day you're looking at stock returns and seeing their difference. So this is like a sample, I'd say. So we take the sample, go down, enter. That's our standard deviation. To annualize it, here's the formula. We take what we just calculated and square rooting it, times it by the square root of our interval again. So 12 equals x times sqrt 12. So 18% standard deviation. And now we calculate. So this by itself can tell you a lot. This tells you it has a high return. A 33% return annual is pretty high. And it's a standard deviation. And from that, we can almost calculate Sharpe. Where's Sharpe? Right here. But we got to find it. Let me insert. Let me just bring this down. We have to calculate. Let me just bring this down. 1 second. We got to calculate. It's just easier if I copy and paste this stuff. We got to calculate them individually, but also annually as well. Because if we don't calculate it annually, it's harder to compare it with other assets. Unless you compare it all in monthly. I mean, that would be fine. But I like to use it because a Sharpe ratio, a good one is like 1 or above, and then great ones are 2 and above. So it's if you do it all in monthly, the ratio is going to be so small that you just don't know, like, honestly how to compare it. But so average excess return, we have to take the risk-free rate. I got this from an MBA website. I believe it was Dartmouth. They just track the prices and check the change. So it's so hard to find because all you get when you're looking at treasury bills are the yields. You don't really get the change in price. So this is the yield, and it's very small, so we're not going to expect too much difference here. And I'm actually going to calculate for the future calculations the average of this and the annualized average of this. So this plus 1 squared of 12 minus 1. All right, there's that. Now we gotta subtract our returns from the risk-free rate. So here we go. This minus this equals, carry it down. All right. Now we take the average of that. Oops. Actually, hold up. Average. Average. And then let's just take the average standard deviation. All right. Now we take, again, we have to put in the formula. I'm just going to copy paste it because it takes too long for me to. All right. So we take this number, square it by that number. Boom. 85% return. Is that right? Oh, I'm taking the okay, hold up. Yeah, it's this number. Okay. And then we take this number, square root it. Then we take this number, square root by 12. There we go. And then these are in percents. That's how you subtract the Sharpe, the return from the risk-free rate for Sharpe. Now, for all we need for Sharpe ratio, let me show you guys the formula for Sharpe ratio. So this is a formula for Sharpe ratio. All right, so it's risk premium, or risk for the, never mind. It's the risk or return for the portfolio minus the risk-free rate divided by the standard deviation for the excess return. So we just calculated all that, and now let's just calculate Sharpe ratio. We gotta take the average. I do the annuals, right, divided by the standard deviation. So Obviously, this is a huge number because it's in a percent form. We do not want percents when we're talking about Sharpe. Let me just make sure all these are formatted. It's number. Okay. Now it's easy, right? We just calculated. We just had to do the hard part, and now it's just we still have to do the market metrics down here, but now we can just calculate skew. This is according to the distribution how skewed it is, not this column. We got to take this column, the returns. Negatively skewed for Microsoft, we got to take the kurtosis. Boom, take down. There's the kurtosis. This means it has, compared to the standard deviation curve, it's got lesser extremes. Distributions in the streams, and which is good for investing. And it's negatively skewed, which isn't that great, but it's not too negatively skewed. So alpha. Now we got to compare it to a benchmark. Let me insert a row. Okay. I usually compare it to the S&P 500, which is the tracks. It's like this select. It's selected by Standards and Poor's, and it's a good metric to see like a big portion of the market how it's performing. So you can't get the index. As far as I know. So I just do an ETF that tracks the index. Oops. So I use VU. It tracks the index. So we gotta do stock history again. Stock history. Stock. Start date. End date. Interval. Headers. Open. Nope. Date. Sorry. Close. Enter. There we go. There's our data. Now we got to calculate the change again. So we take this divided by this minus 1. Carry it down. Now we can calculate alpha, beta, R squared, treynor, correlation, CAPM. But first, I want to show you where these numbers come from. I just give you a visual. So if I take the returns on Microsoft and I take the returns on VU or the market, and I create a graph, a scatter chart. So this is our scatter chart. So the x-axis is the S&P 500, how it performs. So more, if it went up 5%, this would be the dot for 5%, 5.6%. But then the y-axis is Microsoft. So in that specific day, it went up 6%, the S&P 500 did, and Microsoft went up 11%. So it just shows you the different how they performed corresponding to each other. Now we can create a regression line, so trend line. This is beta. This is the slope of beta. This shows you how volatile it is. Let's go to more options here. I can calculate all sorts of the equation here. So we know this Microsoft has a beta of 0.817 and an R squared of 0.4617. R squared goes from 0 to 1, so a 0.46 is pretty good. I mean that gives you a significant enough beta metric in my opinion. If it's less than like 0.2, then probably not as important as a 0.4 or a 0.5. So let's calculate alpha. So you can just take this number and but to manually put it in the formula, you got to put for the alpha, you need the intercept. Intercept of y's right here, and the intercept of x's right here, and it should be right 0.0152. So now we got to take the slope. Slope function, same thing. Take the y's, and take the x's, and there you go. 0.812. Now, if we want to double check ourselves, we can go to Bing and see what the beta is. 0.83. So we're off by 100th place. So it's not that bad. I'd say it's pretty reliable. It's never off by that much, right? So now to calculate R squared, it's an RSQ function. You just put in the same thing, put the y's, put the x's. All right, 0.4. And that's exactly what we got off the chart. Now we take the treynor ratio. Let me show you what the treynor ratio is. Treynor ratio. You basically, it's exactly like Sharpe, except using beta as portfolio return minus risk-free rate divided by the portfolio beta. So what's our return minus risk-free rate? We just calculated that. It's right here. Return excess over, no, which one is it? This one. Divided by beta. Treynor ratio. Right there. Okay. And I don't know if it's a percent or not. It's a ratio. So a Sharpe ratio isn't negative or a percent. So correlation. This is a very important metric because it tells you how correlated and how diversified you can be against the market. So if it's less, you kind of want less. So 0.67. Then expected return. Let me show you. CAPM. This is a asset pricing model created way back in the day. It's basic. Which one should I do? It's this one's fine. So we got to take the risk-free rate minus beta times the market risk premium. Basically, the market times the. So if you want to get an expected return from all this, you do the risk-free rate, which is this number, minus beta times market right here, or not the market, the return you got from the expected, not the expected return, the annualized return, or the return, depends how you're calculating it, minus the risk-free rate. All right. Reference. Okay, the formula's wrong. The formula I just put up yet. The formula's wrong. It should be plus. Okay, that was stressful. So that formula, I don't think this is right. This is not right. It should not be minus. It should be plus. Okay. All right. So that's how you create it. That's how you create all these metrics, and then I just created it really fast. So now the beauty of it is, what if we want to compare it to Apple, right? Just save a mental note of what this was. And of course, it doesn't know what it wants. Apple. All right, so we can see Apple has a higher return over the last 5 years. It has a higher standard deviation, so it should have a lower Sharpe. Yes, it does. And it has a higher beta, so it's going to have lower, yeah, because lower would be in the denominator, lower treynor ratio. So you can just calculate all this stuff. It's skewed to the left. It's it's negatively skewed, and kurtosis is less too. So that's the beauty of it. Once you figure out all these calculations, you can switch one, and let's do Netflix. There you go. That's Netflix. You don't have to, you can compare it. And so this is what you can build a model on. So this is what I've done. I've created a model. So we can just, it saves, it goes to separate sheets. So we can go to my msoft Apple Netflix. You can go to up to 12. And bam. You gotta hit data, stocks. And there we go. And we can compare them on a trend line too. So Netflix is more standard deviation than Apple is, but Microsoft has less of both. But which it has a higher Sharpe, so it can solve for Sharpe for the best, So there's so many things you could do with this data. Like that's the best portfolio for these stocks. Correlation table. There's so much you can calculate just by using. And I'll show you the sheet behind here. This is basically what I did, and this is just for the treynor ratio. It's looking at downside volatility. So I just took out the ones that are below 2.4 in this case, and this is just for the chart. So for the trend line, so you can see the line from 5 years ago. So with all that, you can create so much. I just want to see the potential, then show you guys a snapshot of what you could do with this. So thank you guys for watching. Hopefully you got something out of this, and I'll see you next time.